Howdy, Jacob here. Today we're going to do a more in-depth review on Mativ Holdings, ticker symbol MATV. We're going to go over financials to remind everyone about the company, and then also just want to bring about that even these in-depth videos are not enough for you to do, for you to not do your own stock analysis and company review. This is just hopefully to be in conjunction with it. And everything I say will be in my opinion. Do what you want with it, rip me up if you want. But anyways, market cap 730 million, enterprise value 2.3 billion, a lot of net debt in the paper and forest products industry. Pretty low return on invested capital, but makes sense why their dividend was so high. They actually cut it recently in after Q1 of this year. They cut their dividend down from 40 cents per share per quarter to 10 cents a share per quarter. So cut it down 75%. And the dividend yield is still 2.97%. So not quite the 4% that we wanted in this yield screener that we're looking for, but still a substantial dividend and well above market. And then just to go over some of the notes that I wrote down, we saw that, or that I saw in both their last few quarterly reports and 10Qs and 10Ks. I see that the company became one, mixing Mativ with Nina in March of 2022. They recently completed a sale of part of their business to reduce debt by roughly 600 million. So we did see that enterprise value was a lot greater than the market cap, and that's net debt essentially. And so there was a lot of net debt for this company, and we're seeing that they are taking steps in the right direction to reduce that interest-bearing debt. We see that we'll hopefully see in the Q4 that the sale's gone through, everything looks good, and then we'll see the reduction of debt on their balance sheet. We can see that the reason they did this was they saw with the purpose of accelerating their deleveraging and then focus the business on faster growing and margin expanding opportunities. And so obviously the business they sold off, they believe to be less growing and not super high growth margin businesses or high growth margin business. So that said, we see that their debt on their balance sheet is about 1.7 billion from their most recent 10Q. And we see that a reduction of 500 million would be about 1.2 billion, which in relation to their cash flow, their 5-year average free cash flow is probably around 100, little over 100 million. And so that's still 12 times their 5-year average free cash flow. So still a bit high, but it is good to know that the company's caring about their debt situation. We can see down here, actually, I don't know why I didn't put this in order, but of the 1.7 million in current debt, less than 100 million is due before 2026, 379 million in 2026, a little less than a billion in 2027, and then 330 million roughly thereafter. And so not a lot of debt is very current. We'll see what of the 500 million that they plan on, where they plan on allocating that. Maybe it's all of the 2026, all of the 2020, all of the 2026, all of the prior to 2026, and then maybe 100 mil dipped into that 2027 debt, which would be good for them. Some other notes, we see that in Q4, their dividend, I already said this, their dividend was cut. First dividend payout was about $5.5 million. And so what I was looking at through here, seeing a over 70% payout ratio was actually their previous amount. And so with this, we're seeing about roughly 22 million aggregate payout for this dividend in comparison to the 100 million in 5-year average free cash flow. They can't afford it. And so I'm going to, due to them focusing on deleveraging and margin expansion, I presume that they'll probably keep this dividend pretty consistent. And so I'm saying that the dividend payout that's currently about 20 to 25%, they're probably just going to stick with it and focus a lot on, maybe definitely deleveraging, so paying down some of that debt, and then hopefully, paying out some businesses that aren't maybe producing great cash flow, which may decrease growth in the long term, or in the short term, but will increase margins and make the business more efficient in the future. Management has a lot of commentary on the business each quarter, which is a positive. I just wrote this down to say a lot of management, CEO, CFO, whatever, they basically just point out, hey, it was a great quarter. We looked at revenues increasing like crazy. They don't really focus on the big things. This company talks about a lot of different things, a little bit of free cash flow, a little bit of deleveraging. They talk through it in multiple paragraphs, which is nice. So you can really read the quarterly reports and get a good idea from management's perspective. So that's always a positive. Big negative here, their sales decreased 9.7% in the most recent quarter. So year over year, decrease of almost 10%. Pretty negative there. Earnings recently very, very well impacted due to a $401 million write down of goodwill. That obviously doesn't affect free cash flow. So the free cash flow does not look as poor as earnings do. Comment of the CEO is, as we move forward, in addition to targeting volume and growth initiatives, our teams are focused on increasing operating and capital efficiencies to further enhance cash flows, and multiple actions are underway to reduce spending, optimize our footprint, and continue to deliver working capital efficiencies. So somewhat vague, but good to see that they're focusing on reducing debt, increasing margins, and increasing cash flow. They're due to them selling off part of their business. We see that their business will change a little bit. And so right now, about 80% of their revenue comes from what they call advanced technical materials, 20% from the fiber-based solutions, which is their less growth, less margin expansion part of their business. And so I readjusted my revenue growth numbers to 0 due to the fact, and my margins actually to just down a slightly bit. This is due to the interest debt, and then the revenue change is saying maybe that 80% does grow at 1, 2, 3% a year, but that other business they're probably going to be dwindling down quite a bit faster. So it might see -5 to -10% growth on that side. So in all, the revenue change I'm predicting to be relatively flat. They're heavy on the goodwill and intangibles. We can see on their balance sheet, which is not the best, not the most healthy balance sheet. Obviously, the healthiest balance sheet we see flooded with cash and not a whole lot of debt. And here we see that they have about 914 mil in current assets with total liabilities of 2.4 billion, and then their total assets of 3.1 billion. We see well over a billion is in goodwill and intangibles, which, as they wrote down, 400 million up here, 401 million in the most recent quarter, or in this year at least, we see that that's not the most advantageous portion of your balance sheet. You want to see good investments, good property plant investments, and then good amount of cash on hand in comparison to your debt. So that's a negative for them. And then this is just a breakdown of revenue. 56% from U.S. Revenue comes from U.S., 27% Europe, 17% elsewhere. Percent of sales mostly in industrials, a little bit in protective solutions, filtration, healthcare, release liners. And then they have $25.6 million left in their share repurchases. Right here, I just have their share repurchases. We see that when the stock goes down, it looks like they buy a little bit more shares than when it's up. So that's positive to see. The company is buying back shares when it's cheaper rather than more expensive, whether it's, the right price to buy to give the shareholders the maximum return is a different story. But if I put in my new assumptions based on everything that I reviewed, and again, I looked at the terminal P and price free cash flow based on history. We see that it is well below 10, and that was with higher earnings than I project them to be. So I said 8, still 15% return. Given all that, I'm saying that the company's stock price will have to fall 48% before you get a 15% return, given my updated assumptions. This isn't final word. Everyone, please do your own research. But given the almost 3% dividend yield, I do think it's something to put on the dividend yield screener to where if it does fall even more, we'll hopefully see over 4%. And then 4% dividend yield, and it'll be more attractive at that price point. So thank you and have a good day.